Imagine a company suddenly announces an earth-shattering $2.8 billion in guaranteed multi-year revenue from the absolute biggest tech titans on the planet. You would naturally expect that stock to go completely parabolic, right? So what happens next should feel impossible. Because immediately following this fundamentally game-changing announcement, the stock actually lost nearly a third of its value in a matter of days. Let that sink in. Billions in locked revenue announced, and the market's response was to violently dump the shares. At first glance, this looks like a textbook sell the news trap, or even a hidden signal that the underlying business is secretly failing. But what if the crash had absolutely nothing to do with the company itself? What if the very thing that scared retail investors out of their positions is the exact reason the smart money was quietly backing up the truck? Because when you look closer, you don't find a failing business. You find a violent tug-of-war between a company's massive, undeniable fundamental growth and a completely artificial mechanical market crash. This is Cal Van Mateo, and today we are breaking down the brutal battleground of IREN, a stock that just accidentally created one of the most explosive short squeeze setups nobody is talking about this entire year. We're going to unpack how billions in locked contracts collided with a forced institutional fire sale, why the smartest funds on Wall Street were aggressively buying while everyone else panicked, and the exact price levels where this coiled spring could violently snap upward. If you're the kind of investor who wants to see the setup before the crowd does, do me one quick favor and hit that subscribe button right now. It genuinely helps the channel, and you won't want to miss where this one goes. But before we get too deep into the squeeze metrics, we have to understand the sheer scale of the disconnect currently happening beneath the surface. Right now, IREN is tearing itself in two completely different directions. On the fundamental side, you have a pure-play Bitcoin miner aggressively transitioning into a Tier 1 AI cloud infrastructure provider. The catalyst for this pivot was securing a monumental $2.8 billion in multi-year AI cloud services contracts. In a rational market, that single sentence guarantees long-term success, but the market reality has been entirely different. The recent stock volatility has been driven almost entirely by mechanical institutional flows and forced liquidations, which are completely masking the underlying business boom. And that is exactly what creates an incredibly rare pricing anomaly for investors who actually know where to look. So here's the question worth asking. What if the chart and the company are telling two completely opposite stories? That sounds impressive until you look at who they are actually partnering with to build this infrastructure. This is not a company selling compute power to unproven startups hoping to survive the next funding round. IREN's new client ecosystem is validated by the absolute highest tier of the technology sector. We are talking about officially signed contracts with the true kings of the AI revolution: Microsoft, Nvidia, Perplexity, and Figure AI. Read those names again. Securing capacity agreements with the world's leading hyperscalers fundamentally alters the trajectory of their entire balance sheet. They are pivoting away from the extreme, gut-wrenching volatility of crypto mining into the highly predictable, high-margin world of AI services. When names like these sign on the dotted line, they are not gambling on a maybe. So could it be that the market simply hasn't priced in who is now writing the checks? And that predictability brings us to the one number that changes the math on this company's entire future. Because of these specific $2.8 billion deals, IREN's management team just raised their year-end 2026 annualized run rate revenue target to a staggering $4 billion. Now, on its own, that number is impressive. But here is the single most crucial fact for investors to grasp, and it's the detail that almost nobody is factoring into their models. They do not have to go out and fight for market share to hit this target. Roughly 85% of that $4 billion year-end target is already locked under contract. Sit with that for a second. The demand isn't projected on some hopeful spreadsheet. It is legally bound to their ledger. This isn't a company hoping to grow into a valuation. It's a company that has already signed the growth into existence. So what does a stock deserve to be worth when the future revenue is already guaranteed? But before you get too bullish, there's another layer to this, because building the physical data centers for this compute is anything but cheap. Building out artificial intelligence infrastructure is arguably the most capital-intensive venture on Earth right now, and this is where the entire bear thesis lives. The massive bear case surrounding IREN, and the primary reason many institutional investors have been terrified to even touch it, is the fear of the dilution trap. The assumption goes like this: IREN will have to aggressively issue millions and millions of new shares just to afford all those expensive GPUs, crushing the value of every existing shareholder in the process. It sounds logical, it sounds terrifying, and it's mostly wrong. Here is the completely overlooked fact. These new blue chip contracts mandate heavy customer prepayments. These massive capital inflows actually cover roughly 45% of the associated GPU capital expenditures. Think about how powerful that is. IREN is essentially leveraging their clients' massive balance sheets to fund almost half of their own hardware expansion, actively neutralizing the single biggest bearish fear on the entire table. So if the scariest part of the bear case just quietly evaporated, why is the stock still trading like it's in trouble? Here's where the story starts to get genuinely complicated, because if the funding is secured and the revenue is locked, why on earth did the stock chart just collapse? Let's look at the anatomy of this recent mechanical volatility, because it's honestly wild. On July 20th, when that massive contract was announced, IREN stock gapped up nearly 20%, hitting $40.20 on a massive trading volume of over 93 million shares. The market initially recognized the profound value, exactly like you'd expect, but then, between July 27th and July 29th, the stock went into a brutal, stomach-churning freefall, plunging to a shocking low of $29.31. And then, just as violently as it fell, it staged a massive 30.5% snapback recovery between July 30th and August 3rd, closing near $39. If you were solely looking at the chart with no other context, you would logically assume the company's entire business model was falling apart in real time. But what if the chart was lying to you? Because what was actually happening behind the scenes had absolutely nothing to do with IREN's fundamentals. This crash was a mechanical liquidation, pure and simple. A high-profile, 4x leveraged fund managed by Leopold Aschenbrenner called Situational Awareness was hit with a massive margin call during a hawkish Federal Reserve environment. When you're levered up 4-1 and the macro turns against you, you don't get to choose when to sell. They were forced into the involuntary liquidation of a $401 million position in IREN. They had to blindly dump millions of shares onto the open market at whatever price they could get. This wasn't a verdict on the company, it was an institutional fire sale, a forced seller dumping shares because they had no other choice. And here's the beautiful part. The very moment financial giant Citadel stepped in to absorb that liquidated block, the unnatural selling pressure simply vanished. Instantly, normal market dynamics were restored, driving that massive 30% structural recovery. So if the entire crash was one forced seller, doesn't that mean the panic was completely artificial? And that brings us to the one question that investors actually care about. What were the major financial institutions doing while retail was busy panic selling at the bottom? They were quietly and aggressively buying the dip, while the retail narrative was fixated on a collapsing technical chart and predicting doom. Institutional confidence was actually surging. Total institutional and hedge fund ownership of IREN now sits at a massive 41.08%, and the most recent SEC filings show us exactly who was accumulating the float while everyone else ran for the exits. The Bank of New York Mellon increased its stake by an incredible 1,058%. Read that again. The Merex Group bumped its holdings by a truly jaw-dropping 14,216%. And the Swiss National Bank, one of the most conservative institutions on the planet, stepped in to acquire a brand new position valued at roughly $33 million. The smart money recognized something the panic sellers didn't. A margin call-driven crash isn't a warning sign. It's a generational buying opportunity. So when the most sophisticated money on earth is buying with both hands, whose side of the trade do you really want to be on? But the fallout from all this massive volatility has accidentally set the stage for something far, far more explosive. Wall Street currently sees a massive re-rating on the horizon, and the numbers are eye-opening. Out of 21 covering analysts, the consensus rating is a solid moderate buy. But the actual price targets are what should truly demand your attention. With a current price hovering around $39.06, the average 12-month target sits at $82.71. Do that quick math in your head. That implies an incredible upside potential of over 111%. And the top-tier financial firms are even more aggressive in their modeling. H.C. Wainwright recently raised their target to $90. Cantor Fitzgerald maintains an overweight rating at $99. And Bernstein holds a massive $100 bull case target, contingent entirely on management, proving that their physical AI cloud expansion stays on schedule. So if the analysts covering this stock see it more than doubling, why are the bears still piling in? And despite these massive targets, the retail bears have walked right into a highly dangerous trap of their own making. Because of that extreme mechanical drop we just walked through, short sellers poured into this stock, aggressively assuming the company was fundamentally broken. They saw the chart, believed the panic, and bet big against it. And in doing so, they have unintentionally created one of the most explosive short squeeze setups currently operating anywhere in the market. Let me give you the raw numbers. Right now, there are 93.71 million shares sold short. That represents a staggering 27.61% of the entire public float. Think about what that means. Over a quarter of every tradable share is actively betting against a company that just secured billions in guaranteed revenue. And with a days to cover ratio of 2.3 days, a single high volume breakout threatens to ignite this coiled spring into a massive gamma squeeze. So what happens to all those bears the moment this stock decides to run? So, if we know the powder keg is set and the fuse is exposed, where exactly are the battle lines drawn on the chart? If we look at the options chain, we can see exactly how market makers have tightly boxed this stock into the high 30s. There is an immense floor of put support acting as a structural safety net at the $34, $31, and $30 strikes. That's your cushion. But the ceiling, the true resistance, is a massive call wall sitting right at $40, backed by another heavy wall at $38. This creates a highly compressed zone that I like to call the squeeze zone. And here's why it matters so much. Because IREN is incredibly volatile with a beta of 4.27. If bullish momentum can crack that $40 call wall, market makers will be forced to aggressively buy millions of shares just to hedge their own positions. That forced buying triggers the gamma squeeze. So the real question becomes, what happens when a stock this explosive is compressed this tightly? Which brings us to the actual execution. How do you tactically play this technical setup right now? Let's break down the exact technical execution level by level. Your entry zone sits right here at current market levels between $38.50 and $39.10. You have immediate hard support at the $34 to $34.30 range, which aligns perfectly with that massive options put wall we just talked about. And that liquidation low of $29.31 serves as your ultimate worst case scenario hard floor. Now to the upside. Your immediate resistance is that $40 call wall. If volume genuinely pushes through $40, your first immediate target is the $42.70 gap fill level, and a strong decisive break above that clears the entire runway toward your next major technical resistance at $48. So could this stock realistically clear all those levels in a single breakout week? But how you manage those targets depends entirely on your personal investor timeline. We need to separate the short-term swing traders from the long-term investors here, because these are two completely different games. For the swing traders entering near $39, you must employ strict, non-negotiable risk management. Place a hard stop loss just below that $34 support wall to protect your capital from any sudden macro shocks. Your focus is purely on the breakout of the $40 option wall, riding the gamma squeeze and taking your profits near $48. Simple and disciplined. But for the long-term investors, you are playing an entirely different game. You are accumulating shares in the $34 to $39 range, and you are deliberately holding through any macro-driven dips. You do not panic sell. You let the weak hands hand you their shares. Your focus is entirely on the execution of their locked contracts and the 2027 capacity roadmap. So which kind of investor are you in a setup like this one? And it's that very roadmap that provides the fundamental catalyst driving the next phase of valuation. There are three distinct phases to this valuation journey, and knowing them changes everything. The immediate short squeeze catalyst arrives on August 27th with their Q4 earnings report. Strong revenue conversion metrics here would serve as the fundamental spark needed to crush that $40 resistance. Beyond that, the focus shifts to the 2027 expansion roadmap, where IREN moves into the full execution phase, targeting a massive 1.2 gigawatts of highly scarce grid-connected capacity. And finally, as management executes on their existing prepayments and tech contracts, we reach target realization. This is the inevitable gravitational pull toward that $82.71 plus Wall Street consensus. So if all three catalysts fire in sequence, how high does this thing actually go? Which leads us to the final judgment on whether IREN is truly worth allocating your capital toward. When you synthesize absolutely all of this data, the final verdict becomes incredibly clear. IREN looks like a strong buy, but you have to know exactly what you are buying. You are not buying a speculative software narrative built on hopes and hype. You are buying physical control of highly scarce grid-connected power, the single most valuable resource in the AI age. You are buying a revenue model backed by $2.8 billion in locked tech contracts that actively mitigate equity dilution. And most importantly right now, you are buying into a rare opportunity where the true valuation is temporarily masked by an artificial, mechanical liquidation, all while being heavily compressed by a 27.6% short interest coiled spring. If management simply delivers on what they have already signed, the upside to that $82.71 target is massive. Now, before we wrap up, I want to be completely clear with you. Everything in this video is for educational and informational purposes only, and it is absolutely not financial advice. I am not a licensed financial advisor. Every single number, price target, and setup discussed here comes with real risk, and stocks like IREN with a beta of 4.27 can move violently in both directions. Do your own research, understand your own risk tolerance, and never invest more than you can afford to lose. Your money is your responsibility. With that said, here's the real question I want you to answer for me down in the comments. If IREN's Q4 earnings on August 27th come in strong, do you think this stock crushes that $40 resistance wall and triggers the squeeze, or do the bears manage to hold the line one more time? I genuinely want to know where you stand, so drop your prediction below. If this deep dive brought you real value, smash that like button and subscribe to Calvin Mateo for more objective, no hype financial breakdowns just like this one. I'll see you in the next one.